What's up, guys? It's Cash Flow Cart, and today we are recording the Coca Cola video. I'm going to be doing a full stock analysis from my perspective, which is the perspective of a dividend growth investor. And let's get into it. Okay, quick overview of this video and what we're going to cover because, we could talk about this stock all day. And, I might do a part two at some point. At some point, I'll definitely make another Coke video. But for today, what we're going to cover, the dividend metrics right now, my general thoughts on the stock, or I guess the business, what I love about this. And then we're also going to cover the biggest risk that I think a lot of people overlook that is becoming, increasingly prevalent. We'll get into that. And then we're going to go over my plan on this one, what I'm doing currently with it. And we're also going to look at charts. And then I just wanted to put this here, Coke versus Pepsi. I see a lot of investors think it's some, binary thing where it's one or the other. What stock do you like better, Coke or Pepsi? But I personally don't really like comparing them apples to apples because Pepsi is much more of a snack food business, while Coke is in the beverage industry. So, we're not going to spend too much time on that whole debate when I don't even know if that's apples to apples. But let's get into it. First up, dividend metrics. We're going to look at Seeking Alpha, and I'm just going to go through some of these tabs here. Okay. Starting with their current dividend summary, at the share price as of today, it's early November, the dividend yield is 3.24% on a forward basis. The payout ratio, and that's the earnings payout ratio, guys. Anytime it just says payout ratio, understand that it's calculating that out of the earnings per share, 68.68%. 5-year growth rate on this one is 3.4%. And, obviously that is a little lower of a growth rate than we usually like to see in dividend stocks. But with a business like Coke, that they've been increasing their dividend for 60 years, it's not uncommon that they slow down the rate of increases. And we're going to talk about some great factors of this company that, it might be worth it to have a slower growing dividend with a stock like this. Moving on, let's see. Dividend yield, the 4-year average is sitting around 3%. So, currently you can get a little better starting yield than that 4-year average. And then we look at these yield on cost numbers. They're not blowing anyone away, guys. And that's just a fact of this dividend rate has not increased at a very aggressive pace. Actually hasn't even kept up with inflation in at least in the past 4 to 5 years. So moving on, I'm not going to spend too much time, just over explaining dividend metrics. Here's the growth rates. 1 year, almost 5%. Forward, about 4.5%. We talked about the 3-year compound annual growth rate, 5-year, mid threes. The 10-year, just over 5%. Guys, this is a steady one. Okay, it's not gonna knock your socks off with the compound annual growth rate of the dividend, but this is a pretty impressive business. So let's move on. Dividend safety. I personally like to look at this cash dividend payout ratio because essentially what this is okay, out of their free cash flow they're bringing in every year, how much of that free cash flow are they going to use to return to shareholders in the form of dividends? It's 70, almost 77% for Coke. That's not really a red flag for me just because of how mature and, how diversified this business is. I am definitely not worried about Coke, cutting their dividend or pausing increases for the very foreseeable future. As you can see here, their 5-year average cash dividend payout is sitting a little bit higher than their current, which is good because as they've been able to increase that dividend, they haven't had to eat up a bigger chunk of their free cash flow. So we do like to see this preferably lower than the 5-year average. You can see the sector median, but I don't really know how I feel about that one either because Coke isn't really Coke is a little different, I think, than a lot of the other, competitors in this sector. And then I think that about covers it for what we're going to talk about for dividend metrics. Moving on. Again, guys, I like this dividend, the starting yield and the growth. It doesn't blow me away, but I really like the company. And we're going to talk about valuation a little bit. We're going to look at charts. Just hang tight. What I do love about Coke, and again, Coke is an amazing business. I love their moat. The economic moat that Coke has, I think you could make a strong argument for this being the widest moat of any business in the world. And, I'd rather Warren Buffett explain it than me. So real quick, we're going to look at a quick clip from Warren Buffett. I mean, he's got a lot of great clips talking about Coke. So, you could do your own search, but I just wanted to include one. Let's go.
And Jacobs Pharmacy, you've just seen year after year after year. So now you've got 1.8 billion, 8-ounce servings a day around the world. And when I joined the board in 1988, I don't remember the exact figure, it was a whole lot less. And you've got fewer shares outstanding now, and you've got way more per capitas. And you're gaining share around the world. So those are the kind of businesses I like. I like wonderful brands. You got to take care of them. And but if you take care of a great brand, it's forever. And those are the businesses I like. We own 400 million shares of.
Yeah, I mean, if you guys want to watch the full clip on your own time, you can, but I don't think you can talk about Coke stock without hearing at least a little bit of Warren Buffett speaking about it because, I mean, I think he hits the nail on the head, and it's a business that is going to be around. He uses the words forever, which, I mean, that's powerful. I don't disagree with him, and obviously, if you're kind of a value style investor or a dividend growth investor, you probably relate or you probably resonate. You probably resonate with a lot of the things Warren Buffett says. So again, I'd rather you guys hear it from him than me. What else do I love? The net income and the free cash flow growth. We're going to look at this uptrend, but uptrends are good. We see the net income increasing and we see the free cash flow increasing at similar rates. That's over long periods of time. We like to see that. Margins have been steady and margins have been like so much better than, the sector median, I guess, which we talked about. Their margins are much better than Pepsi's as well. Let's see. Net income margin here, 24% for Coke. The 5-year average is 23%. So they've actually, I guess, improved their margins compared to their 5-year average, while the sector median is 4.5%. I mean, I think with this being said, there's a reason why Coke always trades at, I don't know, a premium, a richer valuation than, most companies in this sector. Most companies in general. Again, we talked about the free cash flow supporting that dividend. Let's keep going. I wanted to include this screenshot just to avoid, clicking through Seeking Alpha and trying to scroll around, show you guys exactly what I want to talk about. So here, again, we talked about the net income margin already. And then apart from that, I like to look at the return on equity, the return on assets, and you like to see both of these high, guys. Obviously, higher return on equity and higher return on assets are going to be better and beneficial for companies. And I've actually seen investors in their screening process use a sum of these two metrics and then have that be like a preliminary screen for stocks. I'm not going that deep into it, but again, it blows away the sector median, and they currently see improvement compared to Coke's 5-year average. It doesn't get much better than that. Let's look at another thing here. We talked about the net income and the free cash flow uptrend. So you guys can see in December 2018, you can see Coke's net income 6.5, trailing 12 months, almost 11. And again, there's ebbs and flows as with any business. I guess this was COVID 2020, 2021. But again, we like that trend. It doesn't have to be perfect, but we identify a trend, and that's the type of businesses we want to be involved with. And then I've shown the free cash flow per share here rather than just the total free cash flow. And you might say, okay, why do you do that? And the reason I've done that is for simplicity's sake. If you look at free cash flow per share, you're going to get an idea of, okay, what are the shares outstanding as well as the free cash flow? Does that make sense? And as a dividend investor, this free cash flow per share is essentially what needs to support the dividends paid, to shareholders of shares outstanding. Again, we see the same thing here. Relatively $1.43 a share. Now $2.35. I don't know if that's a 60 or 70% increase. Again, I'm not a mathematician, but it's good. It's an uptrend, and it's what we like to see. So again, if you guys like using free cash flow per share rather than trying to dive into total free cash flow and shares outstanding, it might make it a little more simple for you. And it's just something I like to do sometimes as a dividend biased investor. Moving on, and this is a forgotten risk. And I think this risk applies mainly to any business right now that is B2C. So business to consumer. And that's honestly an ad campaign, or it's tarnishing the public opinion. As big as social media is nowadays, you guys might not think of this as a real risk, but it really is. I mean, we saw it earlier this year with Target. We saw it with Bud Light. I'm not going to dive into these two cases, but, consumers are willing to boycott, brands if they're whatever views they have, if they don't line up or they feel a certain company doesn't, value them as a consumer and is making controversial statements. Companies or consumers are willing to boycott, or, it causes drama. And I don't see this as being a huge risk with Coke specifically, but I still want to keep it in mind. I mean, I'm sure you guys have seen years and years of famous Coke commercials. They've got the one where people are singing. They had the polar bear. I mean, Coke is kind of a genius of marketing, but again, I don't think any company is immune from kind of this new climate that we see ourselves in today, where consumers are, willing to protest or willing to boycott. For me personally, I love Coca Cola. I don't think there's a lot that they could do that would make me just not drink Coca Cola. But, there's different people who would, I guess, boycott Coca Cola if they made a wrong move. I'm getting a little redundant here, but if a situation like this were to happen, what would that actually affect? And I've included two questions here. Would it actually affect the bottom line, and would it actually affect the share price of the company? with something like Coke, I'm not sure that it would affect the bottom line because this is, like I said, we talked about the wide moat. They have global diversification. I don't know that, you know, a boycott or something like that, drama in one, region of the world, I don't see that affecting the bottom line for Coke. Um, However, it would affect the share price, definitely. I mean, sentiment around names, regardless of what the bottom line is doing, if there's negative sentiment around names, the market tends to overreact. And, if something like this went wrong with Coke, it would affect the share price. I feel like I over explained this whole slide, but that's all right. We'll move on. My plan for this one, and like I said, I love Coke as a company. I love their moat, but putting on my dividend investor hat, I mentioned I'm not blown away by the starting yield. I'll go back to it. I'm not blown away by this starting yield. I'm definitely not blown away by the growth rate. However, I do want to build this position in my portfolio just because of the moat and the safety and, this insane dividend growth streak. Um, and I'm kind of going to let the market give me what it gives me. Okay. So we'll look at the chart and it'll make more sense. But if Coke continues to fall, then I would not mind, building this out to be kind of a cornerstone, I guess, of my portfolio. Because right now it's very small position. All right. I've just started adding. But if I don't see some sort of huge discount on Coke, I might build it to be a medium position. I don't know. We're going to have to see what the market gives me. I am buying, and I guess as low as the share price goes is as big as the position for me is going to be relative to my portfolio, obviously. Um, yeah, like I said, investors pay a premium for this one. And, we didn't even touch on the valuation metrics today because companies like this, they just kind of they trade at their own valuations. It's not really something you can compare to other companies. Let's look at the chart. Okay, guys, we will look at Coca Cola's weekly chart here. Make it a little bigger. Okay, so I've charted this using, weekly candles. This goes back to 2006 back here. So, I mean, first glance at this on a big picture, 20 years almost, you just see a steady uptrend for Coke. I mean, there's been dips here. Obviously, this was '08, and then COVID, there was a huge dip. Now we've kind of seen this dip. I actually talked about this dip in consumer staple stocks in another video on my channel. But overall, the big picture for Coke has been an uptrend, and I've kind of tried to illustrate that here with a few trend lines. Kind of what I mentioned here, if it does fall lower and if it's going to happen, I would expect it in either later this year or through 2024. If I see like more of a real sizable dip in Coke, I would love to build this, to be, like I mentioned, the cornerstone type of stock. But again, if we kind of get this shallow dip that we're seeing right now, I'm going to pick up shares and I'll probably be comfortable, building it into a medium-sized position. But, just with all this being said, guys, I want to reemphasize it's okay to love a company. I think it's pretty undeniable that any investor, can appreciate, at a bare minimum, they can appreciate Coca Cola as a business. But, if you want to make money, you also got to pay attention to the share price and the valuation. And when you enter or when you build out positions, and like I said, I've been nibbling at this one, but very small chunks. And I guess I'm going to wait and see what happens. And I'm hoping I can build it out more. But again, you got to take what the market gives you. Okay. thank you guys for watching this video. I'm recording this on a Sunday. It's been kind of a long weekend, but I really wanted to record this so I can get it out tomorrow. I'm going to be releasing new videos every Monday and Thursday. I'm going to try to keep them light, but very real, very raw type of content. I guess a vlog style videos. I don't know if you guys consider this a vlog, but if you'd like to join this community of dividend investors, please feel free to subscribe or check out other videos. Again, thank you guys so much. I have really just started this channel and the support's been awesome. Whether you know me and you know, support me, or whether you're just a subscriber that has found my channel organically, you know, I can't tell you guys how much I appreciate it. Um, with that being said, everyone have a great week, and I'll see you in the next one.